what does the deal mean for the UK's economic growth? Because across the board, many economists are saying they're very happy a deal is done, but actually it still would have been better for the UK growth had they just stayed in the EU.
Yeah, exactly. Well, good morning. It's obviously better than no deal. Bloomberg Economics had forecast that no deal would knock an extra 1.5% off output in 2021, mainly because trading on World Trade Organization terms would have meant tariffs on many goods. And while just having a deal will soften the economic blow of leaving the EU, Bloomberg Economics predicts the impact will be even further cushioned by a 5% COVID bounce back in 2021, although that forecast was made before this new mutant strain really took hold. But deal or no deal, there was always going to be more friction. The Governor of the Bank of England, Andrew Bailey, said that there's no such thing as a frictionless deal. And let's not forget, this is the biggest reset of an advanced economy's commercial relations since the Second World War. To give just one example, by the government's own estimates, almost 600,000 extra customs declarations will need to be filled out every day. And that's going to take time and money for businesses to organise. And there's still disruption, a risk of disruption at ports, which could lead to food shortages at supermarkets. And we had a preview of that with the chaos in Dover last week when France shut cross-channel traffic. I was there. So Bloomberg Economics predicts that overall the new frictions will mean growth is 0.5 percentage points lower each year for the next decade than if the UK had stayed in the EU.
Of course, those numbers have been run, and the question some people would say is, well, the currency will do the heavy lifting. We've run up 10% from the lows. Do you think that currency has run out of steam? What seems to be the building consensus around the calls on the pound?
Well, yeah, I mean, a weaker pound had helped by making exports cheaper, but you've got to remember that the uncertainty of the past 4.5 years has meant sterling never really fully regained its initial losses in the aftermath of the Brexit vote. And that uncertainty is also translated into weaker business investment, which in the UK has grown well below the levels in the US, Germany and France. And that's a problem that could get worse. You know, a study by University College London and the London School of Economics forecasts that foreign investment into the UK could drop 37% after Brexit. So, you know, a weaker pound is a double-edged sword and certainly not, you know, some sort of Brexit panacea.
What does this mean for the Bank of England? We have a deal that obviously is a little bit more clarity for them, but can we forget now the idea that the BOE will cut rates into negative territory?
It definitely lessens the urgency for more emergency stimulus. But let's face it, the Bank of England was already running out of ammo. Its benchmark interest rates at a record low of 0.1%, and it's already ramped up bond buying this year to help the economy through the pandemic. But negative rates will be more likely if these strict Tier 4 lockdown restrictions last until Easter or beyond. We had Monetary Policy Committee member Gertjan Vlieger telling Bloomberg this month, if the economic recovery slows in 2021, it could be time for negative rates. And interestingly, Simon French at Panmure Gordon, he says the moment when no one thinks negative rates are likely is exactly the moment when the bank could pull the trigger. So just because we've got a deal, and don't forget it's got to get through Parliament first, negative rates could still be on the cards in 2021.